So the last part in this chapter is a discussion of free cash flow valuation. So far what we have focused on is the dividend discount model, and here we are going to actually we are looking at discounting free cash flows instead of dividends. So going back to our intrinsic value definition, we said that intrinsic value of any asset is the present value of expected future cash flows. So in case of stocks, the future cash flows can be dividends, but you can also directly estimate the free cash flow for the company and use that to arrive at the valuation. So this in some sense is a more general approach of doing valuation, because if you think about dividend discount models, practically speaking, those models are only useful for well established firms with a history of paying dividends. If you have a firm that is not currently paying dividends and has never paid dividends before, it would be very difficult for those firms to forecast future dividends. Free cash flows are therefore uh, more widely used and perhaps more general way of arriving at the valuation. So these are commonly referred to as discounted cash flow valuation model. So there are two different approaches here that we can use to arrive at the equity value. One is to use the free cash flow for the entire firm, and that would give you the value of the firm, including the value of debt and value of equity. And from that, when you subtract the value of debt, then what would remain is the value of equity. The other approach is to directly estimate the free cash flows that are available to the equity holders and discount them to get your equity valuation. So we'll look at both of these approaches briefly. So the the basic idea is still the same. We are discounting the future cash flows, right, at an appropriate discount rate. So in that respect, the basic idea is similar to the dividend discount model. The part that is trickier here is estimating the free cash flows. Dividends, they are available, we know what the firm is paying today and so on, but for free cash flows we actually have to estimate those, right? So when we say free cash flow, this is the actual cash flow that the firm is generating. This is not earnings. So earnings is not the actual cash flow, because if you think about, say, depreciation, right, depreciation is a non-cash expense and you deduct depreciation to arrive at the earnings. So earnings is not the actual cash that the firm is generating. So we have to adjust for things like depreciation in order to arrive at the free cash flow. All right, so this is the free cash flow equation, and I want to actually give you a basic intuition behind where this equation actually comes from. So this is the basic format of income statement here, right? You have sales minus cost of goods sold and selling, general and administrative expenses, and then from that you deduct depreciation and you arrive at EBIT, earnings before interest and taxes, also known as operating income, right? So this is earnings before interest and taxes. From that you deduct the interest expense of the firm. So interest expense is tax deductible. Before you arrive at the taxable income, you deduct the interest expense, and then you are left with EBT. EBT is basically your taxable income, and then from your taxable income you deduct taxes, and then you arrive at the net income. Okay, so in this equation that we are looking at for the free cash flow, we start with EBIT. So we are starting here, right, to start with EBIT. We skip over interest expense. So I'll talk about that in a minute, why we are actually skipping over interest expense, and then we directly adjust for taxes. So EBIT times 1 minus the tax rate, right? So EBIT times 1 minus the tax rate. So that's the first term. So far what we have done is we have accounted for taxes starting with EBIT. We skipped the interest expense here. Okay. Uh, and EBIT of course is calculated after deducting depreciation, and as I was saying before, depreciation is a non-cash expense. It's not like a real expense, real money that is going out of the company. So we need to adjust for depreciation by adding it back, right? So that's where we get this addition of depreciation. So EBIT times 1 minus the tax rate, we skip over interest expense plus depreciation. These are the adjustments we make from the income statement, and then we deduct capex and increase in net working capital. So net working capital is assets, I mean current assets minus current liabilities. Capital expenditures, of course, that's your capex. So uh, it current assets are things like inventory, for example. So any investment in inventory needs to be accounted for. Any other investment in net working capital needs to be uh, uh, subtracted here in order to get the free cash flow. Okay, so that's how we get this free cash flow equation. Okay, now the reason we do not include the interest expense here, remember interest expense is a real cash flow. It's the company actually pays interest to its creditors, right, or bondholders. So the interest expense is an actual expense. It's an actual cash outflow. But the reason we are not including the interest expense in our FCFF calculation, this is the free cash flow to the firm. The reason why it is skipped over is because it will be actually used in the denominator. Our denominator is basically the cost of capital, and interest expense is our cost of capital, right? So we don't want to double count it. So we don't use it in the numerator. We account for cost of capital in the denominator. So that's why we skipped over interest expense here. Okay, so this is how you arrive at the free cash flow for the firm. So this is the free cash flow for the entire firm. This is the free cash flow available to all the stakeholders in the company, you including equity holders and debt holders. Okay, so that would be your numerator. You estimate the current free cash flow, you estimate the growth rate of free cash flows, use some sort of a model to estimate or forecast the future free cash flows, and then you have to discount them, right? So what is the discount rate that is used in this case? Well, this is the free cash flow for the entire firm. So the discount rate that is used is WACC, weighted average cost of capital. This is not the cost of equity. It is basically the cost of equity and cost of debt, both included in here, using appropriate capital structure weights, right? So the way this model is written over here, it is basically assuming like multi-stage growth, right? But essentially what we are doing here is we are taking the present value of future cash flows at an appropriate discount rate. And by the way, there is a typo here. This should not be 1 plus FCFF, it should be just FCFF, right? So ignore this one here. That's a typo. So you are taking the free cash flows, future free cash flows, and discounting them at an appropriate discount rate. In multi-stage growth models, you have the terminal value. You assume that after a certain point you will basically have sustainable growth rate, and you actually arrive at the terminal value using this model here, right? And then you discount that back to the present value. This part here, by the way, is similar to D1 over K minus G, right? Instead of dividend, we have the free cash flow. Instead of K, we have the weighted average cost of capital. So what this will give you is the value of the firm, all right? And from the firm value, when you subtract the value of debt, then what remains is the value of equity, right? So in this approach, we are estimating the free cash flows to the entire firm. We are discounting the free cash flows, computing their present value to get the value of the firm, and from the firm value we deduct the value of debt, and then what remains is the value of equity. Okay, so that is one approach. Uh, and the other approach is to get the free cash flow to the equity holders directly. So instead of discounting the free cash flow to the firm, FCFF, we first determine what is the free cash flow to the equity holders. And free cash flow to the equity holders can be obtained by adjusting the free cash flow to the firm for all the cash flows that are going to the debt holders, right? So this is the FCFE, free cash flow to equity holders equation, right? We start with FCFF. So this is the FCFF that we computed earlier, and then we adjust it for interest expense. So interest expense is paid to the debt holders. So any interest that is paid out is deducted here. Of course, interest expense is tax deductible. So we have the after tax interest expense. We take the interest expense and multiply it by 1 minus the corporate tax rate. So that is one adjustment we need to make for the cash flows that is going to the debt holders. The other is the increase in net debt. So for example, if the firm had debt of 100 million last year and this year the total debt is 120 million. So what that means is that firm borrowed on the net, the firm borrowed additional $20 million. So that is extra $20 million that is available to the equity holders of the firm, right? So you add that to the free cash flow to the firm to get the FCFE. If debt is paid down, then that is a cash outflow, and so that would be subtracted out. So any increase in net debt, you add it. Any decrease in debt, you subtract it, right? So those are the two adjustments we need to make to FCFF to get our FCFE. Now FCFF, as we said before, it does not include interest expense, but here we are still deducting interest expense, and the reason for that is when we are using FCFE, our discount rate is not going to be a WACC. Our discount rate is going to be cost of equity. So cost of debt is not included in the discount rate. So we include that in the numerator here. So in this case, we are deducting the interest expense because it is not accounted for in our discount rate. Okay, so once you have FCFE, the rest of the calculation is similar. You take the present value of FCFE at an appropriate discount rate. Discount rate in this case would be cost of equity, that is the KE that you see here, and that's the same cost of equity that we have here, right? This K in our equation, that's our cost of equity that we get from CAPM. Okay, so the only difference between this FCFE model and the dividend discount model is our numerator. Our numerator in case of FCFE in this model is the free cash flow to the equity holders. In earlier case it was the dividend, right? Otherwise the basic idea is the same. There you are taking the present value of future dividends, you are taking the present value of FCFE. So take the present value of FCFE at a discount rate of K. Again, this is written down as a multi-stage growth model, but essentially we are simply taking the present value of future cash flows to the equity holders, and in this case what you are going to get is directly the market value of equity. All right, you get the market value of equity because you use the free cash flow to the equity holder. So that gives us the market value of equity. We don't need to make any other adjustments here. So this is perhaps a more straightforward way versus using the FCFF, because we directly get the market value of equity here. Okay, so we'll work on couple of examples in our handout later on. So some of these calculations would be clear at that time. Okay. So overall, when we look at these models, right, we looked at dividend discount model, the DCF or the discounted cash flow valuation. Models, of course, they differ in practice. Assumptions are different, inputs are different, your estimates of growth rates and discount rates are different. So estimates are always going to be imprecise, and that's why using this models require some due diligence. You need to do some sensitivity analysis. You need to work with a range of discount rates, a range of growth rates, and so on. Sometimes people use a hierarchy of valuation, as I've listed here. Some assets like real estate and all, you already know their market value, so they are easier to put a value on. But other assets like intangibles, like intellectual property, value of growth opportunities, they are harder to put a value on, right? So easier assets are valued first, and then more sort of difficult to value assets are handled later on in a different way. So that is another way of looking at valuation. Okay, so so that completes our discussion from free cash flow valuation. In our next lecture, we will work on practice problems from this chapter.